So we'll move to the real estate / construction industry, right? Okay. So as usual, at the end of this course, I'm going to share the lecture notes with everyone on the group. All right. So now, basically, there is a whole lot of uniqueness in this particular sector, which we are going to take one after the other. And like I said, we are not just looking at the application on QuickBooks alone. We are looking at what is just the normal standard and how does this applies to all AS. All right, because on the assumption that we all might not eventually get to use QuickBooks in our various places of work, right? As soon as we change work and switch roles between different industries, we might end up using another AS. All right, so we are discussing about the exact the general application, right? So the first thing here is about, we look at what are those areas this industry covers. All right, so on a very broad note, this industry in questions also have different areas. All right, we have the development part. That is those guys you get a land, you get a land to make up an estate, you develop it, and you drive down traffic to the place to bring in people to get and all of that. You have the leasing part. You construct a building, then you lease it out to people and they pay on certain intervals, maybe monthly or annually. You have the appraisal part, you have the marketing, you have the management of commercial, those the property management guys, and all of that. So these are just different areas. So we'll look at each of these sides and their various activities, and how does these activities applies to, how do we treat each of those activities on QuickBooks, and how does it even work? How does it work generally? Yeah. Now, what are the major types? Just have four. There's the residential, there's the commercial, there's the industrial, and there's land. Right? The residential here, this is constructing a new building for residential purpose, right? And here, what we are basically saying here is the particular building is not for a commercial purpose. But here we are now looking at the area of how do we account for this particular activity, because here somebody happens to be a client that gave out the contract for us to construct a residential apartment, right? So we have to look at how do we handle and how do we take care of each of these activities in our books if we have this type of transaction, right? The second one here is about the commercial. The commercial here involves you constructing a building for commercial purpose. You construct a market, you construct a mall, you construct different apartments for leasing out to people and all of that. We also need to look at how does this area, what are those peculiarities here, and how do we account for each of those transactions under this heading, right? Then we also look at industrial. You construct factories, warehouses, and all of that. You get a contract from somebody to do that. We also need to look at how does this area, how do we account for all of these activities here. And the last one here is land. You go to a rural area or an urban area, you get the land, you develop it to an estate, and you start selling out. So we need to look at also all the activities from this area as well, right? Now, like I said earlier, that in this particular sector, we have different areas, and each of these areas have their own peculiarities and they have their own kind of activities. The first one here is the development. I already discussed about this earlier. This part, you go somewhere, you buy buy lands, right? You develop it to a very large extent, and you start selling out in units, in different units to people. So what are those activities we have under here? Under here, you have the site clearing, you have all of these site expenses, you pay for constructing like a fence around the whole land just to make it unique. You pay for clearing the whole land and all of that before you start selling it out. So we need to also look at how all these particular transactions, how do we treat them, right? The other one here is the sales and marketing. These guys basically are just the marketers. You are the one to look for the client, and most of the time they act as like an agent between the prospective buyer of a particular property and the owner, right? So you are in charge of marketing and all of that. So these guys also have their own peculiar transactions, right? We have the brokerage. These are also like an agent too. You get an apartment, you pay all this agency fee, the legal fee, and all of that. There are some that this is what the area they specialize in, right? We also look at this. There's a real estate lending. That is the commercial part. You build an apartment, a mall, and all of that, and different ops. You lease it out to people. I have the property management part as well. These guys, you don't have the time to have a whole lot of property. You don't have the time, so you contract it out to people. They manage on your behalf, and you pay them a particular percentage on the rent you receive from that property, right? And they will be the one to cater for all other related activities like repairs or stuff, paying for cleaners and all of that. The whole general management of the property lies with them. So we also need to look at all of these activities under this part, right? So on a more broader note, these are like the 5 different areas in this particular industry with their different activities. All right. So the reason why we need to talk about everything is that you might eventually find yourself in an area where a particular firm that carry out all the activities in all of these areas. So they don't restrict their scope to one part. However, you might have some that just concentrate on 2 of these areas, right? But for completeness, we need to look at all the areas and all their various activities. All right. Now we look at what are the real estate activities and their treatment, right? So we start with a construction. Under the construction, we look at residential or commercial, right? So we have a whole lot of stuff to discuss about here. But before I proceed, so I need to confirm if we all are on the same page. Can I proceed? Okay, great. Now the first one here, we look at the construction part, the residential or commercial, right? The first one here is the project profitability. Now what does this really mean? Basically, right? You agree with me that okay, let's take it one after the other. Let's look at the residential aspect, right? Now, when we're talking about project profitability, we want to know that, fine, for residential, we got a contract to construct a particular property for a customer, right? But the essence of the project profitability here is that basically we want to know how much money we have actually expended on this particular project and how much money we have received, then how much do we have left. All right. I want to know that, okay, in building this particular in constructing this particular building for this customer, how much money do we make in terms of the profit. All right. So each of these qualifies to be a project, and one of the key area in the real estate part is this project profitability. At any point in time, we want to know, because majority of all the real estate activities are actually a project. I want to know at every point in time how much money we make from each of these construction. All right. Now, when we are looking at the project profitability part, like I said, we are looking at how much money do we receive and how much money have we expensed out, and how much do we make as a profit on each of these projects. So the way it works here basically is that on the QuickBooks, you have to set up all of these projects one after the other. As soon as they accrue, we just set them up as a project. All right. And by the time you are processing all your transactions, your customer related transactions, as well as the supplier related transaction for that project, you have to link it with their respective projects. Are we good? Now, when I go ahead to the QuickBooks to practicalize it, you're going to get that better. But I want to take my time to explain. Right. Then another thing again is the purchase of building materials. When you buy these building materials, it does not form part of your expenses, right? It's an outflow of money here, but in this context, to a real estate company, it does not form part of your expenses, right? You are going to capitalize it as part of the total cost of constructing that particular building, be it for commercial, or even if it's going to be for a resident, it's going to be part of your expenses, right? Which is going to be cost of sales, because this particular bill does not belong to you, and the only economic inflow that comes to you after that particular project is just the profit you make from it. Right? You entered into a contract to construct a particular building. You agreed at the contract price of 100 million, but at the end of the day, you discovered that the whole expenses and all of that is 80 million. So which means that your cost of sales is the 80 and you have a profit of 20, right? That is one part, right? Then if it's on the other hand, if it's for commercial, the amount you expended on these materials is going to be capitalized as part of the cost of that building, because it is still under construction, a work in progress, and it belongs to you, compared to the other one that belongs to another person. You are just rendering a service by constructing it. Yeah. So in this case, now for commercial, when you buy the materials here, it forms part of the total cost of that particular building, right? Because this is what you are going to use at the end of the day to know how much money you incurred in building. That is what determines how much you are going to sell out each of this stuff. I don't know. So that is about the purchase of building. So you need to know in what context, and that's what determines the kind of treatment. All right. Because at the end of the day, if the motive of this particular construction is, that's for a commercial one, right? If the motive is for you to be able to sell out in units, for instance, if you're actually building capacity to construct, let's say 100 unit of or a 2-bedroom apartment, all right, and you at the end of the day want to just sell it out in units, all right. So all of the cost incurred in this particular project is going to be capitalized as part of the total amount of building this particular stuff, right? So when you are now done, you now have to reconvert, because the motive here is for you to be able to resell, right? So you have to reconvert them as part of your inventory, because to a very large extent it meets up with what you define as an inventory, because it takes a number of time for you to it's just like you are producing it, Then when you are done, you convert the whole unit. That the whole unit is now going to be the quantity you have available for you to sell. All right. So you need to know this material you are purchasing and that in what context. That's what will determine the kind of treatment you give to that, right? Now, the next one is the payment you make to the contractors and those guys. You also need to know in what context. It's for a residential. It forms part of your cost of sale for that particular project. And if it is for a commercial, it forms part of the cost. Also, going to be capitalized as well as part of the work in progress for constructing that particular all right. Then the next one, the receipt for construction for client, right? That is when you like I said earlier, if you construct on behalf of a customer, the assumption here is that the inception we all agreed at the contract price, right? So the contract price basically here is what you feel the total amount you feel you are going to the customer is going to pay in constructing, and you have added your margin, right? Now, when we're looking at the receipt from this construction, it you have some kind of peculiarities here. There's an assumption that the whole money will not be received at once, all right? But there's an agreement for the contract price, right? That okay, we all agree that to construct this particular stuff, you are going to the contract price, let's say 100 million, right? But this 100 million might not be received at once. Then that is why we look at what we refer to as progress invoicing. So what progress invoicing means basically is that depending on the agreement you have. So if you have an agreement that you are going to progress an invoice to the customer based on the extent you have gone on that construction, and that's what will determine how much they are going to pay. All right. So out of the whole contract price of say 100, you now progress the invoice bit by bit. Let's say 10 million, 5 million till when you are done with the whole construction, right? And on the other hand, if the whole money is just received at once, that, like I said earlier, everything is still based on the kind of agreement you have with the customer. So if the whole money, the whole contract price is received at once, then you treat it as such. All right. Now, the other one is the sales of files after construction. That's what I said earlier, that we for constructing a building, we have a motive of reselling. So when you start selling, it's just like you selling your normal product. Because when you are done with the whole construction, you have reclassified all the items from it being a work in progress to an inventory. Right. So that is that. Then the other one, on brokerage or property management, we have the agency commission. That is when the customer pays, they give you your own portion, the agreed portion, maybe 2% of the whole rent, or 5%, or 10%, or just a flat rate or flat fee. So you get that. As soon as you get that, that forms part of your revenue, right? Then the management fee as well. For a property management firm, they pay you a particular amount for managing the property, right? It's most of the times always expressed as a percentage on the rent, right? Then the property management related expenses, how do we also account for that? You pay for the cleaners, the janitorial service and all of that, for just the smooth running, for electricity and stuff. So these are your own related expenses. All right. Then for the development of land, you have the site clearing. So we also look at how do you also treat each of all of these transactions, right? So like I said earlier, you got hectares or acres of land somewhere to form an estate, and you have to first of all incur a cost to clear, right? You know, this clearing to a very large extent is going to increase the amount you are going to sell this stuff, all right? Because you are improving it for the use of the prospective customers, right? So this site clearing as well also form part of the total cost you bought this land, because at the end of the day, this increases the amount you'll be selling it out, right? Then you have the other development expenses, you do the survey and all of that stuff on the stuff. So it's also going to be added with the total cost of getting the land before you sell out, right? So these are just the basics of each of these activities. So we are taking all these activities one after the other, and we look at how does this really work, all right, and how does this apply here on QB and generally, right? So before I proceed, so I'd like us to ask a few questions before we go ahead and practicalize it. Are we there? So let us ask some questions before I proceed. I need to ensure we all are on the same page. Do you have any questions before I proceed? Kindly ask questions before I proceed to practicalize it on QuickBooks. Are you there? Yeah, please shoot. Joseph, can you ask your question? Please ask your question before we proceed. Okay, we have a question here. Can the construction be cost center in a situation where the company is constructing for another company in a conglomerate? Are you saying that if we have a case where maybe the construction company happens to be a subsidiary of a parent company and they are constructing for the same parent company? Is that what you are saying? Okay, if that is the case here, the reason why it does not meet up with what a cost center is, right? A cost center here, the assumption here is that we only incur cost and no revenue, right? So in this case, we want to believe that the parent company will pay for that service, all right, because to a very large extent they are separate entities. So it's only if the parent company did not pay for, and it's not possible. So they pay for the service, for the particular construction and all of that, and that is when those guys will also expend the money out for that particular construction. So in this case, irrespective, it is still going to be treated as a project in the books of the construction company, which happens to be the subsidiary, right? And even though there was no cost plus, maybe it is the amount they spent on the project, that is the same amount the parent company paid for that particular project, it's still going to be treated as, be set up as a project in the books of the subsidiary. I don't know if what I'm saying is clear. Okay, now let's proceed. Now, we take this one after the other. The first one here is about the project profitability. All right. So I said earlier that for us to be able to track and monitor the performance of each contract, here that we have different customers and we have different projects. So we need to set up each of these projects. Such that we can monitor all the transactions and monitor all the activities. And at the end of the day, we will be able to know how much profit we are able to make on each of these projects. Either is a residential project or a commercial project. All right. So let's take it one after the other. Right. Now, how do you set up a project here? Now, before you even go ahead to do that, let's look at, we also need to ensure that we structured our chart of accounts in such a way to accommodate and all of our activities. So the first thing we need to do is to ensure that we have set up all our revenue streams, all the income streams. So we set them up on the chart, and I believe we all know how to do that. So from your chart of account here, click on account, then new. So we have different income streams. We have sales of land. This is an income stream, right? So you save and new. So you have the sales of house. This is also an income stream, right? And we also have agency fee. This is also an income stream. Then you also have the property management fee. All right, this is also an income stream. Then you have residential construction. All right, this is also an income stream. Yeah. Then for each of these income streams, we also need to set up their respective cost of sales. All right. So you go to new, then the account type here is going to be the cost of sales. Then we also do the same thing. So you have your COS, sales of land. All right. So you have your COS, sales of house. All right. So you have your COS, all right. You have your COS agency fee. All right. So you have your COS property management fee. All right. And you have your COS residential construction. So we have structured our chart now, right, to take into consideration all our income streams and their respective cost of sales. All right. Now, let's take an instance. Now, let's take an instance that we constructed. In this particular year, we constructed 100 units of a 2-bedroom apartment. All right. And good evening, Kutlu. Can you mute your video? All right. So we constructed 100 units, and so I want to take to explain how do we handle that. So let's take an instance that we constructed 100 units, and each of these 100 units is going to be sold out. All right. Now, how do we account for all the related costs of constructing this particular building? All right. Now, we'll be looking at two things here. The first one is about the construction. The second one is when we are done with the construction, conversion of that construction to an inventory, that is to what we sell. All right. Now, so the first thing we are going to do under the chart is to set up a capital work in progress account to take note of all that particular construction, right? So it's going to be like an asset, all right. So you make it a fixed asset. So you can have it to be your other asset. So you can call it the capital work in progress. You save a new. So let's say we are constructing 100 units of 2-bedroom apartment in so Lekki. All right. Now this is going to be a sub under your capital work in progress. So you save a new. So let's say we have another construction. You have your Ikoyi shopping mall that you're also constructing. This is also going to be under. So what we are saying here is that this particular chart is what we are going to use to keep track of all the activities going on here. All right. So all of the activities going on in this particular this particular construction, everything related to the purchase of materials, the labors, everything is going to come here, so that at the end of the day, this account right here is going to reflect how much money we expended in constructing this particular project. All right, so take note that this is a commercial project, right? So we need to know how much was expended, because that is what we are going to use as a basis for how much we are going to sell them out. All right, so having done that, another thing we are going to do is to now set this up as a project. All right, so to set it up as a project, you come to your customer center, and you click on customer from the menu bar. Then you come to customer center. All right, then at the upper left hand side, you click on new customer, then you say add job. So that is a particular project, so you call the project a name. All right, then we have to link this particular project to a customer, so in the assumption that this project is carried out for a particular customer, so you link that. All right, so you click OK. So we already have the project here, such that we can now link it to all the income and expenses related transactions, right? Are we all on the same page? Can I proceed? Okay, great. Now let's say, for instance, for this particular project, now let's start posting all the expenses incurred on this particular construction. So for this construction, we bought the land alone. We bought the land. Can you mute your audio? Okay, we have a question here. Please repeat the linking of the project to the customer. All right. So to link the project, to create the project, you click on customer, then go to your customer center. All right. Then at the upper right hand side, you click on this drop down, then you say add job. So after putting the project name here, click on this drop down to specify what customer this project is meant for. All right. Then you just click on OK. Right, now let's take a scenario that for the construction of this particular project, we actually, for all the costs, we bought the land. All right, and after the land, we did the survey, and after the surveying, we paid for the cement, the sand, and every other stuff, the doors, the plumbing materials, and all of that. So let's look at how do we treat each of this stuff. That is for a commercial construction. All right, so to post all of these expenses, you use your write checks. Normally, we use the write checks to process all expenses, outflow of cash, right? So you come to vendor. So you come to your banking, then write checks, or use your shortcut Control W. All right. So here you specify where this payment was made from, and specify the date. So let's say on the 5th of January we bought the land. All right. So you specify the name. So we bought the land from, so you specify the vendor we bought the land from. Say we bought the land from ABN Community. So you click OK. Then you specify the memo. So we have purchase of 2 acres of land for two-bedroom apartments construction. Alright, so now, so we copy this. Now, ordinarily, this particular transaction here is a normal outflow of money, and ordinarily it's meant to be part of your expenses. But here, in the context here, this particular transaction is going to be capitalized as part of the cost of constructing this particular building, right? On the other hand, if this construction is for a residential, meaning that somebody gave us the contract that, okay, build me this house. You say, okay, this house, build me 2-bedroom apartment. The person give me the money to build on their behalf. So if I now incur these particular expenses for that purpose, it is going to be it's going to be a cost of sale, not going to be capitalized here. Try to know the difference between both. If the particular construction is commercial, then it forms part of, it's going to be capitalized as part of the total cost incurred for that construction, because at the end of the day, we are still going to reclassify it to an inventory when we start selling. All right. But on the other hand, if it's for a residential, this we are not selling it, we are just constructing on behalf of a customer. So in this case, all these costs incurred on this particular construction will now be part of the cost of sales of that income head. Maybe residential construction has its cost of sales account. So that is where it will go. So that at the end of the day, we know that, okay, on residential construction, this is how much we spend, and I've also received the income from the particular customer to construct the building. So you need to know the difference between both. All right. So here we now specify. Ordinarily, we should have specified maybe the cost of sales account here, but because of the context, so the account you are going to specify here is going to be this particular account. So this is the account that keep track of all the costs incurred for this particular construction. So we paid 50 million. So you copy this and you just paste right here. Alright. So on this particular date as well, we also paid for survey for this same vendor. So it goes to that same account. So you put that. Alright, so we also spent this. On this same day, the money was paid out from here. Then you save anew. Alright, so in summary, all those costs incurred for this particular construction, everything in total, as you are incurring it day in, day out in different months, the first thing is maybe the land, the survey, and you start constructing, you pay for the contractors, the labor charge, and all of that. You just keep bringing it here. But however, there are some other costs which not everything is going to come here. For instance, the money used from transporting maybe from the office to the sites to monitor the distance, that is your normal office expenses, your normal transport expense. So all those ones should not be capitalized as part. So the only thing we are capitalizing here is all the costs related to that particular construction to complete it. Alright, so on this same date, in this same month on 20th, from Dangote PLC, we bought from Dangote Cement, we bought 20,000 bags. Alright, so it goes to that same account. So everything that has to do with this particular construction, so it goes here. Are we good? So we save our new. Alright, now we'll continue. So as we are incurring the cost, we are doing that. So let's say we also proceed further. We paid for the contractors. They started building and all of that, so we paid the contractor. So pull up the name here. So you have JQY Building Contractors. So let's say on the 5th of February, so we'll put that here as well. Alright. So everything goes to that same account. Are we good? So you come here. So we do the same thing. Now there's something we have not been doing before, is that under the customer job here, you need to link it that all this transaction is for this Lekki 2-bedroom flat. So you link it to this particular project, right? So you save and close. So let's go and link the previous one we posted also. So that is checks. So we have this. So we link everything. So you come here under the customer job, link it. So what this means is that this particular expenses is for this project. So you save and close. So we do that. Alright, so now why we are using these write checks, this is because of the fact that this particular transaction, we are assuming that they are all cash purchases. Alright, so on the other hand, if it is a credit purchases, just like we discussed under the manufacturing section and the retail, so if it is a credit purchase, you use your enter bill. So which means that we receive that item on credit, maybe now let's say we purchased all these plumbing materials on credit. So we use the write checks. If the payment is in cash, we paid immediately and you deliver the item. But here, you deliver the materials. Let's say we paid part of it and you paid balance later. We deliver now, we pay the whole money at a later time. Alright, so you use your bills. So let's say we bought some plumbing materials. From Plumbit Limited, click OK. So on the 17th of February, we bought plumbing materials for the Lekki flats. Alright, so we bought all of these on credit. So everything still comes to this account. Alright. Okay, so we also link to the project here. So we save and close. Yeah. So by the time we now by the time we are now done, when we actually make the payment, maybe in part or in full, so you now come to your pay bills. Either you click on it from here or you come to vendor, then say pay bills. So you're going to see that bill outstanding. You just click on it, then you input the part payment you paid, maybe 11 million, 10 million, any amount. Even you paid everything in full, just tick it, then select the bank account you paid from and the date, then pay your selected bill. Just the same thing we discussed earlier. So you just need to know which of this stuff you are going to use depending on I don't pause because of you. Quickly drop down and delete for all right. So depending on whatever method we use, maybe the cash or cash purchase or credit purchase that determines which one we are going to use, so it still remains the same. All right. So the main objective here is to ensure that it reports into the right account. All right. So now let's assume we have posted everything: the money for land we bought, the survey, the materials, and all of that, the contractors, and everybody. We have done the old postings, and now we are done with the construction. So we need to now go and check that how much really did we spend in constructing this particular building. All right. So you can easily do that from your chart. So from my chart here, I need to look for that particular chart. So you have it here. You can see you have your day. So far so good. We spent 97 million in the construction. So let's say the total this is 100 unit of 2-bedroom apartments. Are we good? So we spent 97 million for constructing that product, that building. Now the old stuff is now available to be sold out. Now we are done with the construction and you want to start selling now. So what do? I need to now reclassify this from being your work in progress, your capital work in progress, to be an inventory. All right. Now, how do we go about it? Because aside from reclassifying, I also need to consider the units. Because as at now, it means that as part of the total item we have available to be sold out, we have additional 100 units as well as part of our inventory of what we have to be sold out. Right? So what do we do? So what we are going to do now is to just reclassify. All right. So we are reclassifying from the capital working because we are done with the construction to inventory. So how do we go about that? The first thing is to send the items up as an inventory, which is the item here is each of those flats. All right. So I come here under the item list to set it up as an item, that is something I sell. Item, new, it's going to be an inventory part. Then the name here is going to be 2-bedroom. All right. Then you can copy this to the description. All right. Then your cost of sales here is going to be the COS for your commercial for sales of house. Can you see that? Why the income account will be the income from sales of house. Are we good? Then your inventory asset account here is going to be your normal inventory asset, right? Then I click on OK. Then ignore all. All right. So we have set up the item, right? So now back to my chart. So we have a 97, that is the total amount we expended in constructing. So which means that the cost per unit of this particular item is going to be the total 97 divided by 100, right? So which means that the individual stuff cost me a 970. All right, so we need to reclassify from it being a capital work in progress to an inventory so that we can start selling. Because when we say we start selling now, it won't even affect the inventory account. The inventory account is going to be in negative. But we have to reclassify here from the capital work in progress to inventory, right? So what do we do? Now I haven't set up the item as what we sell. So the next thing we are going to do now, so come to vendor, come to inventory activities, then come to adjust quantity / value on hand. So we need to pay some bit of attention here, right? So what we want to do here is we are reclassifying from the capital work in progress to inventory now. Yeah. So what we are doing now is specify the date. That is the date we are done with the construction, and those units are available to be sold out, right? So don't forget that we know that the unit cost now is a 970. Yeah. So we come here. So you specify the date at which the stuff is available to be sold out. All right. So let's say on this date, then your adjustment account here is going to be that capital work in progress, because that is where we are taking out the money from. All right. So that is going to be the adjustment account here. This capital work in progress, and here you select what item. So we are reclassifying this. Can you see that? So you can see the quantity on hand is 0 because we have actually not done the reclassification. So here we are reclassifying now. Our new quantity now is 100 because we have new quantity available. So we are adjusting we are adjusting the quantity and the total value. Are we good? So the new quantity now is 100 and the new value is the 97 million. Are we good? This is the new quantity, which is 100, and this is the new value. All right, and the new quantity now is 100. That is the new 100 units we have to be sold out. And you can see here that the average cost per item is now 970,000. That is the 97 million divided by 100. Are we good? So you click on save and close. Now you are going to discover that the laying 2-bedroom flat now is 0. Can you see that? So which means that we have actually done the reclassification, also taking into consideration the individual units of that item. All right. So when you go up, you see that your inventory have actually increased by that 97. Can you see that? And if I go back to check the item, the quantity available has also increased to 100 units. So it means that at this point, I have this particular item available to be sold out. Can you see that? Which is that 100. So we can now start selling out now, because we are done with the whole construction and we have done the reclassification. So when you are doing the reclassification, you don't use a journal. You can easily use a journal, right? By debiting your inventory and crediting the capital work in progress. But it will not affect that item, because when you are selling, you want it to be reducing. So that when I sell to, I know that I have 98 units left to be sold. All right. So you need to take note of this part, right? So it's something you can easily do with a journal, but using a journal, it will not affect the item ledger. So that's why you need to use the adjust quantity / value on hand. Yeah. And you do your reclassification. So you are adjusting both the quantity and the value. So you are reclassifying from the capital work in progress, because now we are done. And that is the total cost we incurred for that particular construction, right? So you are reclassifying from the capital work in progress to the inventory. All right. So now that is about if you have. She said I should repeat the reclassification if I was too fast. Did anybody have the same issue so that I can easily recap? Aside from Priscilla, did anybody have the same issue? Okay, I should recap. Yeah? Okay, let me go and delete and do it again. But you understand how we arrive at the whole stuff. That now we are done with the construction. And it cost us 97 million. Do you understand that? Do you understand up to that point? And do you understand the way we set up the item? That is the 2-bedroom flat we want to now start selling. Do you understand that one too? Talk to me. Do you understand that too? Okay, no, sir. Okay, what we are saying here. Okay, let me just go and delete and do it again, yeah? Just listen up. So I'm just going to do that again now. So let me go and delete. So let me just revert. Okay, so let's reverse the same transaction. All right. So I want to reverse the whole transaction here. Okay, so you can see it is back to 0. And when you come to your chart, so you can see we have this Lekki. Now, what I'm saying is that we are just done with the construction, right? So the next thing we now want to do is that now we are done with the construction, the whole unit of flat is available to be sold out. All right. So we want to start selling now. So before we start selling now, we need to do the reclassification from the capital work in progress to inventory. All right. So we discovered that for the whole construction, it cost us a 97 million, and we constructed 100 units of a 2-bedroom apartment. So which means that on average, each of those flats is 970,000 unit cost, which is 97 million divided by the 100. Are we good? Now, before the reclassification, we need to go and set up the item, which is what I did here. Come to item list, that is, set up the item because it's something we are going to sell. All right, and which is what we did here. Put the name, the cost of sales account is going to be COS, sales of house, and your income account is going to be sales of house as well. All right, then you say okay. Very straightforward. All right, so ordinarily we should have processed this particular transaction using a journal, right? by just debiting your inventory and crediting the capital working. That is just a normal reclassification, right? The inventory has increased now, your capital work in progress has reduced, right? But when you do it that way, it will not affect your item ledger, because I want to see the balance I have available for that for this new item, because it is something I will sell out, and at every point in time I want to know the balance I have, right? So as soon as I start selling, I want to know that, okay, I've sold 2, the quantity available is 90, so that when people come, I'll still tell them that we still have this number of units left for us to be able to sell out, right? So that is why in doing the reclassification, you use the inventory adjustment. All right. So the basic thing we are doing here is just that we are done with the whole construction, right? Now the stuff is available to be sold out. So we are not spending on this thing again. It's now available to be sold for us to start recouping our money. So we need to do it in such a way by setting up the item as what we sell. All right. And the total cost of construction divided by the total units that we actually constructed forms what our unit cost, and that is going to be our cost of sales as soon as we start selling, right? Now, having done this, the next thing is to now do our reclassification. Now look up, you see that your 2-bedroom flat there is doing 97 million. That is the total capital work in progress. So we want to move this from here to inventory, because it is now available to be sold out, right? So to do your the reclassification, you come to vendor, inventory activities, then come to adjust quantity / value on hand. All right. So you come here, specify your adjustment account to be that capital work in progress account, because that is where you are reclassifying from. All right. Click this. Then you specify the item which we want to reclassify, which is your 2-bedroom. So you can see the quantity on hand there is 0. Right, so we want to increase it because we now have new 100 units available to be sold out. Yeah, so you specify your new quantity here to be 100. All right, so we are adjusting both the quantity and the value. We have the new quantity here to be 100, and what is the new value? The new value is the whole 97 million, right? Which is what we are actually reclassifying. All right, so if you come back here, you now discover that your average cost per item here is 970,000, which is the whole 97 divided by 100. That is a 970. That is your cost per each of those items. That is what cost us to construct each of those flats. It's 970, which means that when we want to sell, if our sales policy is by applying a margin, so it means that we just apply our margin on this cost. Maybe their margin is 25% on cost, 20% or 30%. That's what we use to determine the sales price. All right. So now we know the average cost per item. Are we good? So by saving this particular transaction is going to credit this capital work in progress. So crediting is taking the money off and debiting your inventory that now we have 100 units to be sold out. All right. Are we good? So we have 100 units to be sold out, right? And at the same time, still updating the item ledger. That aside from the fact that we have actually done the reclassification, it also increased the balance we have for this item to 100. So when I'm done, I just say save and close. All right. So if you now come back to the item now, click on list, then come to your item list, you discover that you now have 100 units of this particular 2-bedroom to be sold out. So by the time we start selling now, that means we have started making our money back, and it keep increasing. It keep reducing. So if I sell 1, reduce to 99, I sell 2, until when we are done selling. Are we good? I don't know if we all are on the same page now. Do you still have more questions? Are you there? Do you still have more questions? Okay, great. So now that we have done the reclassification now, so let's start selling. So when we start selling now, we use your sales receipt. It's either you use sales receipt or you use invoice. You use your sales receipt if we sold in cash. That is, those people came, we started doing our marketing that this so real estate company has new 2-bedroom that is for sale, and each unit now you can see that our average cost per unit is 970. So let's say we sell for a 1.2 million per that item. All right, so we sell for a 1.2, so it means that our profit on each of those flats is a 230, right? But the sales price is actually not fixed. We can sell at any amount depending on whatever agreement we have with the customer. But we already have our base that the average cost per unit is a 970. Yeah, so you can either use your sales receipt or use invoice. So you use your sales receipt, actually a cash sale, meaning that you pay, I give you the key to your stuff and it becomes yours. We sign the document, right? That is one hand. On the other hand, if probably you are paying in bits, all right, so you create an invoice to capture the total amount. So as soon as you are paying me, I'm reducing it. So that means you first of all create an invoice and you use your receipt payment to be reducing it. So we take the both scenario. So let's say we have Mr. David. He walks up to us and say, wow, I like this apartment, it's a new apartment and I love it, I want to pay for it. We say, how much is it? 1.2. It transferred immediately to our bank account. So what do? You use your create sales receipt. You can access it from your dashboard, or you can either click on customer here, then you say enter sales receipt. Right? So you select the customer. Then deposit to account, the money was paid to my Zenith Bank. Then on what date? Alright. Then the item here, that what are you buying? So you bought the 2-bedroom. The quantity here is bought 1 and he bought it for 1.2 million. Alright. So here you have to specify the project, that is, you are linking it. Alright. So we are linking the project here. Alright, so you have in 1.2. So immediately you save this transaction now, the bank account is debited and the sales account is credited. And at the same time, this particular item is reduced to the tune of the amount that is being sold. And also at this same time, your cost of sales is also calculated, which means that as your sales is posted with 1.2, on the other hand, your cost of sales of 970 is also happening behind the scene. Alright. So I'm going to save and close. Are we good? So we have sold out 1. So if I come to my list of items now, you discover that it has reduced to 99. So it means that we still have 99 units of flat left to be sold out. Right. Now, let's take the other scenario. If somebody bought and you have to pay bit by bit. Alright. So you have to raise an invoice in that regard. So let's say we have a real estate firm walks up to us and say they want to buy 15 units. And that 15 units, they just want to buy so that they can also resell. Alright? So you come here. So we have ABC Realtors. That's the name of the firm. They bought on credit. And on this date, they bought 15 units of this item from us. Alright, so the quantity here is 15. Then you put the rate. So we sold it to this firm 1,250,000. So that's what I was saying earlier, that there is no standard. Alright, so there's no limit to the amount you can sell this. Yeah, so so you have this on our invoice, that is the 17.5. You save and close. Ignore all. Alright. So now, when they start paying gradually, then you come to same customer and say receive payment. Or you click on receive payment from your dashboard. Come to customer. Then you come to your receive payment. Select the same customer. Select the date of payment, then select the bank account. Alright. Now we have an outstanding of 17.5, right? So let's say out of this money he paid 10. Alright, so we have this to be here. Alright, so which means that they've actually paid parts out of this old stuff. Then when we are done, it means the outstanding left is a 7.5. So I go ahead and save. Okay, so when you come back here now, you discover that the outstanding has reduced. When you select the customer name, you can see we have 7.5 there. So as they are paying, so you post the rest. So the stuff here is depending on whatever basis. Either the customer paid immediately and we give them the access, or they pay now and they pay bit by bit. Alright, so whichever one is a cash sale, you use your sales receipt. Is a credit sale, you use your invoice. Alright, so that is, now we have started selling. Alright, so when I go back now, if I check our POL now, you discover that, can you see for our POL, you can see for this particular thing we have sold how many? We have sold 16, and this is the total cost of the 16, that is 16.7. And on this 16, our unit cost is 14,550. Can you see that? Which is your 970,000. Alright, for each of those items. Can you see that the sales is 18.7 and the cost of sales is 14? So the difference between the two is our gross profit. Alright, so when I go back to check my item now, you discover that the item will have reduced by another 15 that I just sold. Now you can see that's reduced to 85. Alright, can you see that? Okay, so do we have more questions? So what we just discussed basically is about the commercial construction, where you have to construct a building and for a particular period. Then when you are done, you reclassify it to an inventory and you start selling. Do we have more questions? Hello, are we there? Do we have more questions? Okay, I can proceed here. Now let's look at those other ones where you have the agency. All those ones are very easy. Alright, if you receive the agency fee, you're only just to raise an invoice to that particular owner of the house, and they pay your agency fee, then you recognize as your revenue. That is very straightforward. And for the property management fee as well, when you get your fee for managing the property, if it's a credit sale, you also use an invoice. And if you receive your money immediately, you use your sales receipt. Those ones are straightforward. Now, the other hand is if we actually constructed a building on behalf of a customer. So that is a residential building. So for a residential building now, as against using the old stuff here, for the residential building, the item will not set the item up here because we don't buy and sell. Hello? Faruko de John to Long, má pè mí pa. Mo ti send the chat sí WhatsApp, màá send owó sí ẹ. Mo ti send chat sí WhatsApp. Tó bá ti wá online, mo bá ti wá online, tó bá dọ̀la, ó lè pèèyàn pa, má pè mí pa jàre. Pè mí lọ́la. Now the other part is the aspect of the residential building. So the thing here is, any item we constructed on behalf of a customer is not going to form part of the item here. No, because it does not belong to us. We are just constructing on behalf of somebody. So what happens is, all the money we receive for that construction goes to your revenue, and all the money you expended, you buy material, you pay for labor, goes to the cost of sales directly. So it's not going to a capital work in progress like the ones we constructed for commercial purpose. And we are not even reclassifying anything to inventory, because we are not selling. We are actually constructing on behalf of a person, and our only difference there is just the difference between what they paid us and the amount we spend is our profit here. So as soon as they are paying us, the money goes, you raise an invoice to that effect. Alright? But on the other hand, as we are now spending money out on the project, then it's not going to be part of your cost of sales. However, depending on the kind of agreement you have with those the customer, maybe they are going to pay you based on the level you have gotten to on the construction. So as soon as they pay you, our own objective here is just that you raise the invoice to the tune of the amount you get from them. And if it is on the other hand, such that they pay you the total money at once or in certain intervals, so you raise an invoice for the total amount, and as soon as they are paying you, use your receipt payment to reduce it. But if they pay you the total money at once, you have agreed that, okay, to build this, you are going to collect 150 million. So you just raise the sales receipt for that straight. Alright? So that is the key difference between both. Then the same treatment we give to this construction is also what we give to land. So if probably we have some land, we don't want to build on it, we just want to develop the land and resell, just for people to now come and build. So all the land is also going to be treated as a capital work in progress, and all the related costs, the site clearing and all of that development stuff goes as part, or it's going to be part of the capital work in progress amount. So when we are done and we see that that particular land is now available to be sold out, then you have to do your reclassification, and it's going to also form part of your item, because it's also what we sell, right? So that is the same treatment you give to the building we construct, also what we give to the land we develop to be sold out for to customers, right? So we'll have to take questions now. Our time has been fast spent. For those that have network issues, so I'm going to send the video download link. So probably you go through those videos, and you can now come up with, the recorded lectures we sent to the group. I think you're on the group, right? So you sent to the group. It's going to be uploaded on the drive. So I send the link to the group. You request for access. I grant you the access. Then you download. All right? Are we good? So that is just it about. So for those that have network issues and all of that, you go through the video, the stuff that will be sent to the group. So as during the process, during the time you go through the video, if I have any questions, so you can drop it on the group or you chat me personally. I will attend to it, because I discovered that some people have network issues and all of that. So in the meantime, I'm going to welcome questions before we round up the class for today. So you can come up with your questions so that I can attend to that. Yeah, okay. In the situation whereby you have a mobilization fee, so the mobilization fee, everything will not go to your revenue at once. So the mobilization fee is going to go to like a deferred income, because we have actually not earned the stuff, because we have not commenced any construction. So as soon as you continue the construction, so you now reclassify their money from your deferred income to revenue. All right. So if you get the mobilization fee from the client for the construction, so the mobilization fee, first of all, when they give you the mobilization fee, you debit your bank and credit a deferred income. So deferred income is more like a liability account. So as soon as you earn some part of that amount, then you raise a journal again, you debit the deferred income and credit your revenue. Are you good? Do we have more questions? Do we have more questions? So in the absence of more questions, okay, for the progress invoicing, right? So like I said earlier, we have already agreed on a contract price, right? Then we'll now be creating an invoice for the part of the amount which we have actually certified on that project, which we are to now recognize as a revenue. So for the contract price, right? There's something we call an estimate here. The estimate is going to capture the whole contract price. All right. So let's say we agreed on a contract price of 100 million, but we are going to always get the money here based on the progress we have made on that construction. All right. So you can see the estimate here. So the estimate here basically is a non-posting transaction. What I mean by a non-posting transaction is it does not have any effect on your report. It's just a non-posting transaction because a customer have actually not made any commitment here to pay us any money. All right. So you raise an estimate. So the estimate captures the total amount, right? All right. So you specify what service you are rendering and all of that. Then when you are done creating an estimate, when you come to your create invoice, you are going to have the option of, do you want to create a part of the invoice or you are creating all. So that's where you now specify what part of that invoice, how much out of the estimate are you converting to an invoice. All right. So that's how you'll be progressing from the estimate one after the other. So it's just like the estimate covers the total amount, while the invoice is just taking part of the estimate gradually till when you consume all the total amount on the estimate. I don't know if that is clear. Now, do we have any more question? For those that are not here, as soon as you go through the video, if you have any question, you can drop it on the group or send to me personally. All right. So in the absence of more questions, I think we call it a day, right? So thank you for your time, even though the turnout was very low tonight. But for those that participated and asked questions, thank you for your time. So we meet by weekend. Today's class was actually a makeup class because of the yesterday contingency that came up. So we meet again by weekend. So I think we have 3 more industries left. So we meet again by weekend, and we look at the next industry by weekend. All right.